In this video, we will explore what Warren Buffett considers the two most important ideas in investing. Both of these ideas come out of the book, The Intelligent Investor by Benjamin Graham. A must-read for any serious investor. Buffett says that the three most important words in investing is margin of safety. In The Intelligent Investor, a chapter is devoted to the investor and market fluctuations. These two ideas are the most important ideas in investing according to Buffett. But why? Let's explore these ideas. Before we delve deeper into both these ideas, we must work around the premise that when you buy a stock, you are buying a part ownership of the business. Each business has an intrinsic value. This term has become common lingo in the investment circles, and often used loosely to justify the buying or selling of a stock. There is also no clear definition of what intrinsic value is. Buffett defines intrinsic value as the amount of money you can take out of the business between now and Judgment Day discounted at an appropriate rate. Mr. Buffett looks at the future earning power of the business in calculating intrinsic value, while other investors look to the assets. In Walter Schloss's Factors to Make Money in the Stock Market, he suggests to buy assets at a discount instead of buying earnings. He says earnings can change dramatically in a short time. Usually assets change slowly. One has to know much more about a company if one buys earnings. Walter Schloss's fund returned a compounded annual growth rate of 21.3% over a 28-year period. Over the 28 years, a $10,000 investment with Walter Schloss would have returned you more than $2 million. While both Mr. Buffett and Mr. Schloss find the intrinsic value of companies in different ways, what is important to notice is that both investors look at buying a stock as buying a piece of a business. Stocks fluctuate in price daily and sometimes wildly. If you are buying a piece of a business and you are a prudent and sensible businessman, will you let the stock market tell you how much your business is worth? On the contrary, as a prudent and sensible businessman, you will allow the stock market to serve you prices daily. No one is forcing you to buy or sell. According to Graham, price fluctuations only have one significant meaning to the true investor. Price fluctuations provide the investor with an opportunity to buy wisely when prices fall sharply and sell wisely when prices have advanced a great deal. At other times, he will do better if he forgets about the stock market and focus on the operating results of the business. Price fluctuations is one part of the equation that increases the margin of safety when prices go down and reduces the margin of safety when prices go up. Yes, you heard that right. The margin of safety increases when the price goes down and decreases or becomes non-existent when prices rise. According to Graham, the margin of safety can be satisfied in two ways. Buffett stated both ways when he said, "It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Walter Schloss gets his margin of safety through low prices. He says, "Price is the most important factor to use in relation to value." Graham too believes that low prices create a margin of safety. It is our argument that a sufficiently low price can turn a security of mediocre quality into a sound investment opportunity. For if the price is low enough to create a substantial margin of safety, that security thereby meets our criteria for investment. Another way that Graham and Schloss advocate a larger margin of safety is through diversification. Schloss had been known to hold around 100 stocks at any one time. Graham used a roulette wheel to illustrate how diversification controls risk for the investor. In the game of roulette, if a person bets $1 on a single number, he is paid $35 profit when they win. But the chances are 37 to 1 that the person loses. If one bets $1 on all the numbers, he is guaranteed to lose $2 on each spin. This is a negative margin of safety. But suppose the winner received $39 instead of $35 with every spin of the wheel. This is a small but important margin of safety. The more numbers one wagers, the better the chance of gain. In fact, one can be certain of a $2 gain if one bets on all numbers. I have personally used this strategy in the Singapore stock market with success. There are many businesses in Singapore selling less than book value and liquidating value. Catalysts that cause gains are improved earnings, takeovers, and asset divestments by the companies. The risk with this strategy is that you do not know when the catalyst will occur. And as most of the companies are mediocre, I lost money on a few. However, a decent double-digit return was achieved despite losses. Before we move on to Warren Buffett's investment strategy, please like and subscribe. Warren Buffett, despite being mentored by Graham, does not believe in diversification. Both Buffett and Charlie Munger believe that diversification is a protection from ignorance. They say that it is irrational to place money in your 10th best idea when you can put most of your money in your best. Success comes from being very patient but aggressive when the time comes. According to Charlie Munger, in 1988, They place 80% of their money into Coca-Cola, buying up 6.2% of the company. Buffett said that there is nothing magical about discount to book value. How then does Buffett manage his risk? He looks to the earning power of the business and how strong and durable a competitive advantage the business has. The stronger the economics of the business, the more foreseeable the earning power of the business. In the 90s, Buffett famously avoided technology stocks while the rest of the market was piling into them. It was clear to him that the internet will change the world. But what he didn't know was who was going to win. Buffett looks for businesses with excellent economics. These businesses tend to be businesses that sell commodity-like products like soft drinks, razor blades, candy, and furniture with a durable competitive advantage through their brand. Think of Coke, Gillette, See's Candies, and the Nebraska Furniture Mart. While each of these businesses had different economics, all of them were phenomenal brands. Phenomenal brands that Buffett understood allowed him to conservatively estimate the future earning power of the business and come to a reasonable conclusion of the value of the business. Contrast this to Graham and Schloss's strategy, where the economics is seldom considered. They win statistically through buying many companies for less than they are worth and wait for something good to happen. If this video gave you some insight, please like, share, and subscribe to keep us motivated to produce more videos that will help your financial future.